We've been given a really important job to do on behalf of the American people by Congress, and we've been given the tools to do it. And my colleagues and I are focused exclusively on carrying out that mission. We consider the best thinking, the best theory, and the best evidence. We have disparate points of view, which we debate extensively and come to a perspective and try to set monetary policy to achieve maximum employment in a context of price stability. That's what we do. We don't consider political factors or things like that. And so that's who we are, that's what we do, and that's just the way it's always going to be for us.
Okay, Steve, and then Howard.
Steve Leisman, CNBC. Thank you, Mr. Chairman. Can you explain how the stock market being at and near all-time high, corporate spreads being very tight, how does the level of the market factor into your decisions to raise interest rates? Is there a concern on your part? And then as sort of a second and related part, can you tell us what happens in 2020 and 2021 that, I know you can't tell us, you're shaking your head, that prompts you, the Fed, to think that the rates need to still be above neutral in that time period? Thank you.
Sure. So in terms of financial markets and monetary policy, as we say in our statement every cycle, we do take financial conditions into consideration because broader financial conditions do affect the broader economy, and they're one of the many things that we take into account. The part of it that we control, though, is what we do with the federal funds rate, and that has effects out through the full interest rate curve and into financial asset prices generally. So the answer is we take everything into account, but and broader financial conditions are just one of the things that we take into account. In terms of 20 and 21, your question was why the funds rate needs to be above neutral. So you're right. Some of the participants have mostly very modest overshoots of their personal estimates of neutral, a couple 3 years out. It's far out into the future. I think it's hard to be confident that that's the way things are going to be. What we're going to be doing as we go through time is asking at every meeting whether monetary policy is set to achieve our goals, and I think that's an assessment of where policy will need to be some years down the road, and I'll leave it at that.
Howard.
Thanks. Howard Stein with Reuters. Chair Powell, I think, is this too good to be true? Because you've got 4 years here of unemployment below 4%, very low, substantially below NAIRU, what appears to be NAIRU, but no reaction of inflation there. And so I don't think that's ever happened since the 1960s. Why do you think it's going to happen now? Or in the alternative, is this forecast for unemployment just being driven by your confidence intervals to the extent that, well, we don't know what else to do, so just extend the line out till something happens?
No, you're right. The committee forecasts, what they show in general is an economy where unemployment remains in the high and middle threes throughout the entire forecast period, and inflation remains very close to 2%. That is what the forecast shows. And that is based on our understanding of the way the inflation process works now, on the fact that the inflation seems to be fairly non-reactive to changes in slack. That is to say, a flat Phillips curve. And it's a world of strongly anchored inflation expectations. And that's not just our forecast. That's many forecasts. So that is the forecast. So you may ask, I mean, the sense is, what does the longer run natural rate of unemployment mean? And so that really is a longer run concept that we think the economy will return to over the longer run. But obviously that longer run, it's not creating problems in the short run for that forecast. Now, let's just admit that the inflation process has changed dramatically from where it was in the 1960s to where it is now. It's in a good place now. We can't take for granted that it will remain the way it is. And, we will be, of course, watching carefully. If inflation reacts more strongly or more weakly to this strong economy, then we'll adjust policy appropriately.
If I could follow up on that, what are you buying with interest rates?
Well, interest rates, of course, have effects on growth. Have effects. I mean, I guess your question was, what are you buying by raising interest rates? The question is, what would the economy look like if you didn't raise rates? It would look very different, I think, if you didn't raise rates. We're always trying to, work our way between the two problems we face. One is that if we move too quickly, we can snuff out a recovery unnecessarily, and inflation falls short of its 2% target. Or if we move too slowly, we have an economy that can overheat. So that's happened through history. We don't see any signs of that now, but we're always trying to navigate between those two shoals. And we think that gradually, raising interest rates is the way that we kind of take both of those risks seriously.
Sam and then Marty.
Thanks very much. Sam Fleming from the Financial Times. The Fed has recently been saying that financial stability risks are moderate. What kind of developments could prompt a change in that assessment to elevated risks? And is there an argument for moving the countercyclical capital buffer even when risks are moderate, rather than waiting until the risks are seen as elevated, which arguably could be too late? Thanks.
So I think one of the most important lessons from the financial crisis is really the importance of the stability of the financial system. And so since the financial crisis, as you're aware, we've had a major focus on building up our monitoring of financial conditions and financial stability issues. We've also put in place many, many initiatives to strengthen the financial system through higher capital and better regulation, more transparency, central clearing, margins on uncleared derivatives, all kinds of things like that, which are meant to strengthen the financial system. We've done many of those things, and we feel that the financial system's in a much better place. As we look at conditions most recently, and this was at our last meeting, and it was in our minutes for the last meeting, quarterly, we have a briefing at the FOMC and also at the board of the staff's views on financial stability. And the staff judged the overall vulnerabilities to be moderate. If you dig into the different aspects of that question, households or balance sheets are in good shape. Employment is high, wages are rising, that sort of thing. The banking system, as I mentioned, is much higher capital, much higher liquidity, is much stronger. If you look at asset prices, it is true that some asset prices are in the upper reach of their historical ranges. And then if you look at non-financial corporates, you get there is the story of leverage there. So it's not that there aren't any vulnerabilities, but we see them as moderate. Now you ask about the countercyclical capital buffer. The countercyclical capital buffer is a tool that we added to our toolkit, I think, finally back in 2016. We said that we would deploy it when vulnerabilities were meaningfully above normal. We revisit that on a regular schedule, and the last time we revisited it was, I think, sometime last year, and concluded that the test was not met. As I mentioned at the last briefing, the assessment was that vulnerabilities were moderate, but it remains a tool for our toolkit that we can deploy, when and as we feel appropriate.
Do you see the chances of needing to deploy it as increasing?
As I said, I think I'm in the camp of seeing vulnerabilities as relatively moderate. I think the financial system, I think another thing that we learned in the crisis is that we need to be alert to the buildup of vulnerabilities as a long expansion continues. I don't see that in troubling amounts at this point, but I think it's appropriate for us to monitor that very carefully.
Marty and then Heather.
Marty Krutzinger with the Associated Press. The researchers at the European Central Bank this week put out a paper saying that the impact of a trade war on the U.S. could be dire, that the U.S. economy could drop by 2% in the first year after a widespread trade war. Could you talk about the discussion you've had? Your policy statement doesn't mention the trade tensions. You did not mention them. What kind of outlook do you have right now for the trade war?
Sure. So I guess I need to start by saying that we're not responsible for trade policy, and we don't comment on particular, trade actions and that sort of thing. But you will have seen that we have this very extensive network of business contacts around the country through the reserve banks largely, and we've been hearing a rising chorus of concerns from businesses all over the country about disruption of supply chains, materials cost increases, and loss of markets and things like that. So we've been hearing quite a lot of that, and the Reserve Bank presidents talk about it in the meeting, and it goes in the minutes. So we're very transparent about hearing all that. I think if you look at the aggregate the performance of the U.S. economy at an aggregate at a national level, it's hard to see much happening at this point. And you can look at it the other way. You can ask if all of the tariffs that have been announced are applied, what would be the effect at the aggregate level? And they're still relatively small. We worry about a couple of things. One is loss of business confidence, which could reduce investment. Again, we don't really see effects that we can measure yet. Also, the possibility of a financial market reaction over time to unexpected trade developments. More than anything, though, I would worry in the longer run where this is going. If the end place we get to is lower tariffs, that would be good. I think trade generally supports productivity, supports higher incomes, and fair trade under internationally accepted rules can be a good thing. I think if this perhaps inadvertently goes to a place where we have widespread tariffs that remain in place for a long time, a more protectionist world, that's going to be bad for the United States economy and for American workers and families and also for other economies.